Welcome back to Investing Talk Podcast. Today, we're tackling a question many of you might be asking right now. Is Crescent Energy a good time to buy? We're going to really try to cut through the noise, look at the source material, and pull out the most important insights for you. We've got some, pretty interesting reports and company info here on Crescent Energy.
Exactly. And our job here is to kind of peel back the layers for you, looking at, everything from their financial health and market position to what analysts are saying, and importantly, what risks might be out there that you need to be aware of.
Absolutely. Now, before we really dive in, just a quick note. If you find this analysis helpful, please remember to subscribe, hit that like button, maybe leave us a comment. It really does help us out. Also, feel free to consider buying us coffee to support the show. We appreciate it. And maybe most importantly, if there's a specific company you'd like us to look into next, just drop it in the comments below. Your input really does guide where we go next. Okay, let's unpack this. So before we get bogged down in the numbers, maybe let's set the stage. Who is Crescent Energy? What's their mission? Where do they operate? Give us the lay of the land.
Right. So Crescent Energy, their core mission, as they state it, is about investing in energy assets. But the key goal is delivering better returns, and they emphasize doing that through strong operations and good stewardship. Operationally, they're mainly in Texas and the Rockies, key energy areas, and they talk a lot about their long-life resource base. Basically, assets that should produce for a good while, plus a deep inventory of what they call high-return drilling locations. So they're picking their spots carefully, it seems. They also make a point about stewardship capital, employees, environment, communities. That's increasingly important, as you know.
Okay, that stewardship angle and the long-life resources,
Yeah.
it definitely paints a picture. So how do they stack up? What's their standing in the pretty crowded U.S. energy industry?
Well, this is actually quite interesting. What stands out in the sources is that they're noted as a top Eagle Ford producer. And the Eagle Ford, as you know, it's a major shale play. Being a top producer there isn't insignificant. It suggests, strong operations, efficiency, a real presence. So this strong position, plus what are described as high-quality assets, that makes them pretty attractive, especially perhaps for long-term investors looking past the day-to-day noise.
Right, being a top player in a key area like Eagle Ford certainly counts for something. Okay, so that's the operational side, but
Yeah.
let's get into the financials. That's where the rubber meets the road, right? Our sources highlight this pretty impressive 30% compound annual growth rate in production since 2020. That sounds fantastic on the surface, but there's usually a flip side, isn't there?
Yes, and this is where it gets a bit more nuanced. It raises that classic question. Despite that really strong production growth and 30% CAGR is quite something, the company actually reported a net loss over the last 12 months.
A net loss with that kind of growth.
Exactly. So it suggests maybe challenges in profitability, perhaps heavy investment, maybe some non-cash items, even with all that new production coming online.
Okay, so growth is solid, but it's not flowing straight to the bottom line right now.
Yeah.
Interesting paradox. However, one thing that is highlighted as a strength is their cash flow. How does that square with the net loss?
Ah, yes. And this is really crucial for energy companies. While the net income shows red, they apparently benefit from a strong cash flow position. Cash flow is king in this business, right? For operations, debt, flexibility, and importantly, it's supported by a robust hedge program.
Hedging, so locking in prices.
Pretty much. It's like insurance against those wild commodity price swings. It doesn't guarantee they capture every bit of upside, but it protects the downside. This gives them stability in their cash flow, which is a very favorable position compared to peers who might be more exposed. It's just good risk management.
That makes sense.
Yeah.
Focusing on that cash flow stability is key. So, operations, financials. Let's talk valuation and technicals. What's the market thinking and what are the charts saying? Sources mention that because of the net loss, there's no standard PE ratio, but there is a forward PE.
Correct. The trailing PE doesn't really work here, but the forward PE based on expected earnings is 6.16. And the sources describe this as competitive, maybe even leaning towards undervalued compared to peers. But it's important, for energy companies, valuation often isn't just about PE. It's cash flow, reserves, production growth. Those often carry more weight.
Right, PE is just one piece of the puzzle in energy. Okay, so that forward PE is something to note. Now, what about the price itself? This is where it gets interesting for potential buyers. The stock's been volatile, right? A 52-week range from around $6.83 up to almost $17. Where are we now?
Yeah, quite a range. The recent price we're seeing is around $9.25. And interestingly, the Fear and Greed Index, it's apparently indicating fear.
Fear, so potentially a contrarian signal.
It can be. especially in cyclical sectors like energy. When fear is high, sometimes it means the short-term sellers are flushed out, potentially creating an opportunity for longer-term folks, assuming the fundamentals hold up.
Okay, that sentiment context is useful. What about the pure technicals? Moving averages, RSI.
All right, looking at those, the 50-day simple moving average is at $8.93. The 200-day SMA is quite a bit higher at $11.89.
So the price, $9.25, is above the 50-day but below the 200-day. What does that suggest?
It suggests a recent downturn in the longer trend, obviously, but maybe some short-term stabilization or bounce since it's above the 50-day. The gap shows it's been trending down, but maybe that momentum is slowing. And the relative strength index, the RSI, is at 53.13.
53.13, so neutral?
Exactly, smack in the middle. It's not screaming overbought, but it's definitely not screaming oversold either. Despite the price drop from the highs, it suggests maybe more of a consolidation or reevaluation than a panic.
Okay, a mixed bag technically, but not extreme. Let's shift to what the professionals are saying, the analysts.
Well, the consensus seems pretty clear here. Most analysts covering Crescent rate it as a buy, and they have a consensus target price of $16.
$16.
Right.
Compared to the current $9.25. That's significant implied upside.
It certainly is. It shows a strong belief in the company's prospects, likely looking through the current net loss towards that growth, cash flow, and maybe the asset quality.
That's a strong vote of confidence. What about company-specific news? Anything happening lately that might be driving this sentiment or could impact things soon?
Well, connecting the dots, recent M&A in the sector generally, plus Crescent's own strategic moves are probably factors. Specifically, they've scheduled their Q2 2025 earnings release and call for August 5th. That's obviously a key date.
Right. Earnings calls are always make or break.
Definitely. It's where we'll get updates on profitability, operations, outlook. It could really move the needle, confirm the analyst view, or, raise new questions.
And you mentioned financial positioning. They've been active with their debt recently.
Yes, quite active. They announced early results for a tender offer, basically buying back up to $500 million of their older, higher interest 9.25% senior notes due 2028. And at the same time, they priced an upsized $600 million private placement of new 8.375% senior notes, but these are due way out in 2034.
So refinancing, lowering interest potentially, and pushing out the maturity date.
Exactly. It's strategic debt management, reduces near-term pressure, potentially improves the interest expense profile, and gives them more financial runway. Smart moves for long-term stability.
Okay, makes sense. Now, no investment is without risk, especially energy. What are the key risks listeners should be aware of with Crescent?
Well, the big one specific to the stock is just the inherent volatility in energy markets. Commodity prices, oil, gas, they can swing dramatically. Even with hedging, big price drops hurt revenue and profit. That's just the nature of the beast. And operationally, they depend on successful drilling, hitting those production targets without major issues or cost overruns.
And thinking bigger picture, macro risks.
Yeah, the macro environment is huge. Global economic slowdowns mean less energy demand, lower prices. That hits everyone. And, of course, geopolitics, conflicts, OPEC decisions, trade policy, all that can whipsaw energy markets and impact Crescent. It's a globally connected sector.
Definitely lots to watch there. So putting it all together, the good, the bad, the potential. What's the overall rating or recommendation from the sources?
The sources consolidate this into a rating of 7 out of 10 for Crescent Energy.
7 out of 10. So strong, but not perfect.
Exactly. It signals, strong competitive position, good long-term growth potential, but it clearly comes with that caveat about the volatility and the current profitability picture. It needs careful consideration.
Okay, 7 out of 10. For listeners thinking, all right, maybe I'm interested, what's the suggested entry range considering that volatility?
Given the recent swings, the sources recommend an entry price range between $8.50 and $9.50 for a, let's say, more stable entry point. And this really brings up the question who this is for. Given the need for patience, the growth story, the cash flow focus, it seems much better suited for long-term investors, not a quick flip.
Right. Definitely sounds like a longer game. And for managing that longer-term investment, any guidance on stop losses or take profit levels?
Yes. The guidance suggests a stop loss around the $8 mark. That's your risk management, protecting against a sharp downturn. And on the upside, a take profit target somewhere between $12 and $14 is suggested as a moderate target for locking in some gains. So overall, it looks promising long-term, but patience and watching the market are absolutely key.
Okay, so we really unpacked Crescent Energy. Seems like a company with impressive growth, strong cash flow, but navigating those current profit hurdles and market swings. yet backed by positive analysts and some smart financial footwork.
Absolutely. It's a great case study, really, in blending that fundamental strength, especially cash flow here, with market sentiment, looking at future catalysts. But always, always keeping a sharp eye on the risks and making sure the investment timeline fits your goals.
Right. So here's a final thought to leave you with. Given Crescent's strong position in a volatile sector and these recent debt moves shaping their future, how much does the current market fear really matter for its long-term potential? And if you were a long-term investor, what specific things, maybe besides just the profit number, would you be watching most closely? Something to chew on. Thank you for joining us for this analysis. We really hope this gave you some valuable insights into Crescent Energy. We look forward to our next discussion with you.